Hello and welcome to Steps to Investing. This week on the show I was joined by Rebecca Tunstall, who is a private client investment manager at Rathbone, and we spoke about risk, how to analyse an investment, and we have some top tips for first-time investors. So stay tuned. And don't forget to like and subscribe to the channel to stay in touch. Rebecca, welcome to the programme. Perhaps if I could start by asking you just to introduce yourself and maybe tell us a little bit about what you do.
So I'm Rebecca Tunstall. I work for Rathbones. I've been working in the industry for almost 15 years now, and I've almost been at Rathbones for 9 of those years. And what Rathbones does is we manage money for private clients, so effectively individuals just like yourself. And what we do is we look at a client, we talk to them, we understand what they're looking for, and then we recommend different types of investments to them. We manage pensions, trusts, charities, and some more complicated instruments for clients.
So part of your role then would be assessing the needs of a client, whether that's retiring at a certain age perhaps, or generating growth or income, is that right?
Yeah, so the conversation is about what are you trying to achieve in the long term? And it's not to say that you only have one goal. Most people have 2 or 3 goals in their lifetime. It might be, I'm going to get married in 5 years' time. I know I want to upgrade my house in 10 years' time, and then I want to retire. So it's about working out which of those pots are the most important, how we're going to get to our goal in the best possible way.
And am I right in saying that to be a customer you need to have a certain amount of wealth, is that right?
Yes, so firms like myself, you need at least 250,000 in order to invest with us, but there are certainly other options for people that have less than that.
Okay. And the other thing we were just talking about a little bit before we started recording was about part of your role being around helping people who might not be normally considering investment, specifically women. And I thought that was just really interesting. We did a programme a couple of weeks ago about the differences between men and women investing. Mm-hmm. It sounds like you've experienced something similar, that women tend to be better long-term investors.
Women do tend to be better long-term investors. They do tend to stick to their guns a little bit more when it comes to investing. But I think the big thing is that they also recognise where their skill sets lie.
Right.
They're not afraid to use somebody like Rathbones or one of the other options out there to do the management for them, rather than necessarily going out there and doing it themselves.
Okay, got you. Well, today, as I said, we're talking about investment analytics and analysing investments. Let's start by thinking about classic investment mistakes. You must have seen a few over the years. What are your investment cliches or errors?
I think when you get new clients in, one of the biggest things that I hear from new clients or friends of mine is, oh, my mate down the pub said that I should buy this. What do you think, Rebecca? And invariably that's a bad idea. I don't think I've ever had one that thought, yeah, that's really great. So that would be the number one error that people make. The other thing that I think people don't think about or just aren't aware of is risk. What does risk mean? Because I think some people, they might have a portfolio or some money that they have managed maybe through Hargreaves or whatever it is, and they've bought 4 or 5 things because someone's told them about it, but they don't understand the risks that they're taking with that money that are in those 4 or 5 different assets.
That's interesting. I mean, I suppose one of the things, going back to talking about a person's objectives, might just be capital preservation. Let's hang on to what I've got rather than necessarily try and grow it or do anything more risky with it.
So when we're looking at portfolios or managing money for people, there are 2 ways that you can put risk into the money that you have. One is through asset allocation. What I mean by that is how risky are the things that I'm investing in. And assets and things that you can buy range from very low risk to very high risk. And it's about making sure that we have a balance. Time horizon is really important when you're thinking about that. So the longer your time horizon, theoretically, the more risk that you can take. So it's about identifying what our goals are and making sure that we're taking the appropriate level of risk.
And how do you sort of assess risk in that way then? What makes a specific investment more risky than another one?
So there are 2 things that we tend to look for. First of all, if you're looking at your whole pot, how much do I have in one individual thing? Because we think something called diversification is really important, and diversification is effectively not having all of your eggs in one basket. So it's about making sure that we have a really good spread, so that if something happens to one particular thing, say I bought some Amazon shares and all of a sudden everyone is really worried about how much paper they use and thinking more environmentally, and something happens to that share, it won't affect our entire portfolio because we have lots of other things in there as well. Secondly, when we're looking at the types of things that we're buying, so there are lots of different types of things that you can buy in a portfolio. There are funds, and funds tend to be that where you delegate the responsibility to somebody else who might buy you 20, 50, 100 different things in that fund. So it's quite well diversified. But also you can go out and buy stocks and shares. So you can buy something like a little bit of an ownership in Tesco's or Amazon or ASOS. But that's going to be much more risky because the money that you've put in is into that one company alone rather than spreading it over 200.
That's really interesting. So you've got risk on the one hand, but you've also got opportunity on the other. You know, what is a good investment? How on earth do you make that decision for somebody?
It's a difficult question, actually, and everyone invests slightly differently. So you will find that people have a different focus when they try and invest. Some people are looking for income, and there are certain stocks that you would look at for someone that particularly is looking for income. Someone who's looking for long-term growth and thinking about their pension, you might be looking at a different type of stock. So it depends what's most appropriate for the requirements of the client. We tend to try and think about themes. You know, what are the themes going forward? What's going to be important to people in 1, 3, 5, 10 years' time that aren't going to be so affected by maybe what Trump tweets next? So thinking about scarcity, you know, water scarcity, scarcity of supply, those are quite big things. Technology is everywhere now, but it's trying to find companies that use it in a really innovative way that makes it really interesting, and trying to play those themes over the longer term.
You mentioned it interesting their income, and that some investors are interested in income. And I just wanted to ask you about this because if you look at it sort of dispassionately, you might say, well, income's only suitable for retirees, people who are needing an income to live off. But actually, it can be really important for a younger investor as well, if you reinvest that income.
That's correct. So we certainly find that people that are retired are more focused on income because actually they're not at the stage of life where they want to see huge growth in their portfolios. Going back to what you said, it's much more about capital preservation, and they're looking to take some income from those investments. But we find that there's a huge swathe of people that sit in that sort of 5 to 7 year view that want some growth but also want some income, because if you reinvest that, you've got the beauty of compounding, which really adds value. So if someone starts investing at 25 and if someone starts investing at 35, by the time they retire, the one who started at 25 has double what the one at 35 has if it's just reinvested on a continuous basis. So there is a real power to that, yes.
That's fascinating. So let's ask you a personal question. We tend to ask all of our guests this. Can you tell us a little bit about your own investing and what you like to do when you're investing?
So I am a high-risk investor.
Oh, wow. Okay.
But I understand the risks that I'm taking, and I'm comfortable with the risks that I take with my own money. I'm investing my pension, so I know that I'm not going to be accessing that for a depressingly long time. So I'm comfortable with the risks that I take. But when we look at risk and we talk to people, it's all about that sleep at night factor. My sister and I invest for my sister as well. We have the same time horizon. We're almost exactly the same age. My sister just cannot take risk.
Right.
She cannot sleep at night. I invest for her like I would maybe one of my retired ladies. So it's completely subjective and a very personal decision.
That's fascinating. So just to sum up, what key points, the sort of three things, if you were talking to a first-time investor, what should they watch out for?
First of all, don't be afraid to use someone to make the decisions for you. Nutmeg, Wealthsimple, or possibly a Rathbones if you have a little bit more money. They will take your risk into consideration. So rather than going to Hargreaves and choosing 3 or 4 things yourself, they are actually looking at the risk that's most suitable to you. Secondly, ask questions. If you're going and you're meeting somebody, don't be afraid to ask questions. Generally speaking, they've heard them all before. I've certainly been asked where to find home alarms before. There is no silly question, but that's really, really important. You've got to feel comfortable with the person that you're working with. And thirdly, fees. Everyone is very conscious of the cost that they're paying. You do need to pay some fees because people are helping you and doing the risk management for you. But be conscious of the amount that you're paying.
That's great. Thank you very much.
Thank you.
Well, that's all we have time for. Thank you for watching. Don't forget, as I said, to like and subscribe to the channel, and do let us know what you're thinking in the comment section below. Thanks again, and see you next time. Goodbye.